Singapore has upgraded its economic growth forecast for 2026 to between 2% and 4%, marking an upward revision from the previous range of 1 to 3%. The Ministry of Trade and Industry announced the change on Tuesday, February 10, 2026, citing stronger than expected global economic momentum and sustained demand from the artificial intelligence infrastructure boom. The upgrade follows confirmation that Singapore's economy grew 5.0% in 2025, surpassing the government's advance estimate of 4.8%, though slightly below the 5.3% expansion recorded in 2024. The revised forecast reflects the economy's strong finish to 2025 and improving conditions among Singapore's key trading partners. Singapore's fourth quarter performance exceeded expectations. GDP expanded 6.9% year-on-year in the October to December period, accelerating sharply from 4.6% growth in the third quarter. This beat both the median analyst forecast of 6.5% and the government's advance estimate of 5.7%. On a quarter-on-quarter seasonally adjusted basis, the economy grew 2.1%, moderating from 2.6% in the previous quarter. The ministry attributed the strong performance to robust manufacturing output, particularly in electronics and biomedical clusters, alongside continued strength in financial services. The 5.0% full-year 2025 growth represents Singapore's strongest annual expansion since 2021. Trade Ministry Chief Economist Yong Yik Wei told reporters that the upgraded 2026 forecast factors in sustained momentum from the AI investment boom alongside expectations for accommodative monetary conditions and expansionary fiscal policies in major economies, including the United States, Germany, and Japan. This performance marks a significant transition. While 2025 benefited from recovery effects in manufacturing and tourism, 2026 growth will depend more on structural competitiveness, productivity improvements, and sustained global demand beyond cyclical rebounds. The shift from recovery-driven expansion toward trend-based growth explains why the upgraded forecast, though optimistic, remains within a moderate range. Manufacturing drove the acceleration in late 2025. The sector posted 15.0% year-on-year growth in the fourth quarter, up sharply from 4.9% in the third quarter. Electronics and biomedical manufacturing led the expansion. The electronics cluster benefited from sustained global demand for AI-related semiconductors, servers, and related products. The infocoms and consumer electronics segment expanded by 67.6% in the third quarter, driven by higher production of servers and server components. This surge underscores Singapore's strategic role in the global AI supply chain. Biomedical manufacturing recorded robust fourth quarter growth, primarily from pharmaceutical production. However, this sector exhibited significant volatility. Barclays economist Brian Tan noted that biomedical's output spiked to a peak in October 2025, reaching levels 201% above the average monthly production during June to August. This surge came from an unexpectedly large order for a high-value active pharmaceutical ingredient. The spike proved temporary. By December, production had declined sharply. Tan raised his 2026 GDP growth forecast to 3.5% from 2.5%, but penciled in a mild quarter-on-quarter contraction of 0.5% for the first quarter of 2026, attributing this to the normalization of biomedical's output after the windfall. Beyond manufacturing, other sectors contributed to the broad-based expansion. Wholesale trade expanded 3.9% year-on-year in the third quarter, driven by strong sales in electronic components, telecommunications equipment, and computer products. The machinery, equipment, and supplies segment recorded high sales volumes, reflecting robust demand for AI-enabled electronics. The information and communications sector grew 4.7% year-on-year in the third quarter. Growth was led by IT and information services, including data hosting and internet search activities, as well as digital content and games publishing. Financial services maintained steady growth throughout 2025, supported by traditional banking activities and increased demand for wealth management services. Labor market conditions remained tight throughout 2025, supporting wage growth in key sectors. However, manpower constraints persist, particularly in technology and advanced manufacturing. This creates a delicate balance. Strong employment supports household income and consumption, but wage pressures can raise business costs if productivity gains do not keep pace. Balancing these dynamics will be critical for maintaining competitiveness in 2026. Not all sectors performed strongly. Construction growth came in at 4.6% year-on-year in the fourth quarter, down from 5.6% in the third quarter. The food and beverage services sector remained weak, recording marginal 0.2% growth in the fourth quarter after contracting 1.9% in the third quarter. For full year 2025, the sector contracted 0.9%, extending the 1.1% decline in 2024, reflecting ongoing changes in consumer dining habits and spending patterns. Enterprise Singapore upgraded its forecast for non-oil domestic exports growth in 2026 to 2 to 4%, up from 0 to 2% previously. The agency cited robust AI-related demand and elevated gold prices as key supports, though it cautioned that downside risks include potential escalation in trade tensions or a sharp correction in AI-related investment demand. With this context in place, attention turns to what the upgraded forecast means for global conditions and policy responses. The Ministry of Trade and Industry noted that the global economy outperformed expectations in the fourth quarter of 2025, with most major economies delivering stronger than anticipated growth. Global trade activity remained resilient despite U.S. tariffs, likely reflecting effective tariff rates lower than announced headline rates and successful trade diversion through supply chain adjustments. The ministry expects momentum from late 2025 to carry into early 2026. The sustained AI investment boom should continue supporting demand for semiconductors and related products. Expansionary fiscal policies in major economies and accommodative global financial conditions should provide additional support. The GDP growth outlook for Singapore's key trading partners has improved compared to November's assessment. However, officials noted that growth for most economies is still expected to ease from 2025 levels, partly due to the full-year impact of U.S. tariffs and rising trade barriers weighing on non-AI-related global trade. The United States economy is expected to remain relatively resilient, supported by sustained AI-related investment, even as consumer spending moderates. China's growth is projected to moderate due to slower export performance. The Eurozone is expected to experience slower growth as industrial activity weakens. Despite the upgrade, significant downside risks remain. First, while global economic uncertainty has receded since the first half of 2025, it remains elevated. A renewed escalation in tariff actions or geopolitical tensions could trigger pullbacks in business hiring, investment, and spending. Second, an escalation in risk-off sentiment could trigger sharp corrections in financial markets with spillovers to broader economic activity. The strong performance of technology stocks has raised valuation concerns that could materialize if investor sentiment shifts. Third, the concentration of Singapore's recent growth in AI-related sectors creates vulnerability to any slowdown in that investment cycle. If companies scale back data center construction or semiconductor purchases, Singapore's electronics manufacturing and related services would face significant headwinds. Fourth, sectoral tariffs by the United States remain uncertain. While branded pharmaceutical tariffs have been put on hold, the ultimate scope and level remain unclear. Singapore's exports of pharmaceuticals, semiconductors, and consumer electronics to the United States account for about 40% of exports to that market, making the economy particularly sensitive to U.S. trade policy. These considerations explain why policymakers have adopted a measured stance despite positive momentum. The Monetary Authority of Singapore maintains a watchful position. Chief Economist Edward Robinson stated that the central bank remains comfortable with its assessment that inflation is heading toward its 1 to 2% forecast range. Robinson noted that MAS is now in an appropriate position to respond effectively to any risks to medium-term price stability. The upgraded forecast carries different implications across stakeholder groups. For residents, the outlook suggests stable employment conditions will continue, supporting household income even as cost pressures persist. For businesses, moderate growth calls for focus on productivity and efficiency rather than rapid expansion. Companies are encouraged to invest in digital adoption, automation, and workforce skills to maintain competitiveness amid rising costs. For policymakers, the upgrade enables more targeted fiscal planning. With the recovery phase complete, broad-based stimulus gives way to strategic investments in workforce capabilities, research and development, and digital infrastructure. Fiscal support is expected to be targeted rather than expansive, focusing on long-term structural resilience without necessarily accelerating short-term growth. This approach reflects an effort to strengthen the economy's foundations against future shocks. For Singapore's economy broadly, the upgraded forecast reflects both strengths and vulnerabilities. The city-state's heavy reliance on global trade makes it highly sensitive to international conditions. Recent performance demonstrates the ability to benefit from specific trends like the AI infrastructure build-out, while highlighting vulnerabilities to sector-specific shocks. The manufacturing sector's dominance underscores Singapore's competitive advantages in high-value production. Skilled workforce, advanced infrastructure, strong intellectual property protections, and business-friendly regulations have made Singapore attractive for semiconductor fabrication, pharmaceutical production, and precision engineering. However, the concentration in electronics and biomedicals, which together account for more than half of industrial production, creates vulnerability to sector-specific cycles. The recent biomedicals volatility, with production swinging dramatically over months, illustrates this challenge. The weak performance of consumer-facing sectors suggests domestic demand has not kept pace with export-led growth. Analysts have responded positively to the upgrade while maintaining caution. Barclays' forecast of 3.5% falls in the middle of the new official range, suggesting forecasters see both upside potential and downside risks. The volatility in biomedicals and concentration of growth in specific sectors raise questions about sustainability. The global context is noteworthy. While many advanced economies grapple with slowdowns, Singapore's upgrade reflects its positioning in global value chains. The concentration of AI-related manufacturing in Asia, with Singapore as a key node, has provided tailwinds not available to economies with different structures. Looking ahead, the government's budget statement, scheduled for later this week, is expected to provide details on fiscal measures and a refresh of economic strategies. How priorities are balanced against fiscal sustainability and near-term support will be closely watched as Singapore navigates the transition from recovery to sustainable growth. Singapore's 2026 forecast reflects a moment of relative strength amid global uncertainty. The economy transitions from recovery-driven expansion to trend-based growth, supported by AI-related demand and manufacturing resilience. The upgraded range of 2 to 4% acknowledges positive momentum while recognizing significant risks remain. The coming months will test whether supporting factors prove durable. Continued strong AI infrastructure demand, stable global trade, and accommodative policies would support outcomes toward the upper end of the forecast range. Conversely, trade tensions, financial volatility, or sharp corrections in technology investment could push results toward the lower end. For Singapore, the path forward is one of continuity and adjustment, steady expansion through structural investments and policy flexibility, emphasizing long-term resilience over short-term acceleration. The upgraded forecast provides cautious optimism but underscores the need for continued vigilance and adaptive policy responses in an uncertain global environment.